Hello, we are Group A11. My name is Alice.
My name is Finley.
My name's Alasdair, and today we are studying 3 case studies.
I will do the case 1,
Which
is quantitative easing policy.
And I'll be studying case 2, which is AI boom and Taiwan's economic growth.
And I'll be doing case 3, which is the Iran-US oil constraints.
And after all the 3 cases study, we will have a group discussion QA part.
Let's go!
Hello, I'm Sun Jiahui. I will do question 1. Today I will analyze the evolution of quantitative easing in the US and Japan. The US Federal utilized QE to counter acute financial shocks. QE1 through QE3 stabilized frozen credit markets after the 2008 crash, while QE4 responded to the 2020 pandemic. The core objective was shift market stabilization. Conversely, the Bank of Japan faced chronic deflection, trajecting from the original 2001 QE to 2010 comprehensive easing and finally 2013 QQE. Japan's goal was structural, aggressively expanding asset purchases to break a deflationary mindset and hit a 2% inflation target. And I want to talk about conventional policy via quantitative easing. To understand these trajectories, we must contrast conventional policy with QE tools. First, conventional monetary policy is target short-term interest rate. Central bank utilize the discount rate, reserve requirements, and open market operation involving short-term government debt. On the other hand, quantitative easing deploy once traditional rates hit the zero lower bound. Central bank directly expand the monetary base by shifting to large-scale purchases of long-term government bonds and private risky assets. Third, the liquidity trap. This shift to unconventional tools is necessitated by a liquidity trap. This occurs when interest rates are so low that the public prefers holding cash over investing or spending. It refers to figure 1, the money market graph. The money demand curve becomes perfectly horizontal. At this stage, conventional monetary expansion is simply absorbed as cash hoards without lowering rates further. QE bypasses this trap by bypassing short-term markets to inject liquidity directly into the broader system, lowering long-term yields. Last, transmission channel and the ADAS model. QE transmits to the broader economy primarily through the portfolio rebalancing effect. By purchasing safe assets, central bank push investors toward riskier corporate assets, lowering borrowing costs and stimulate private investment. Refer to Figure 2, the ADAS framework. In macroeconomic theory, QE is designed to shift the aggregate demand curve to the right. In the US, this rightward shift primarily targets output stabilization and real GDP growth. In Japan, the critical objective of shifting the AD curve was raising the general price level to escape chronic deflation. In conclusion, while both nations executed massive asset purchases, the US applied QE as a temporary defense against acute crisis, whereas Japan weaponized it as a long-term structural tool against deflation. Thank you for listening.
So we have a few questions here. The first one is, you mentioned the portfolio rebalancing effect. How does this actually lower borrowing costs for corporations?
When the central bank buys safe long-term government bonds, it drives their yields down. To find better returns, investors are forced to shift their capital into riskier assets, like corporate bonds. This increased demand lowers corporate bonds yields, which directly reduces borrowing costs for businesses, making it cheaper for them to invest and expand.
Okay, so why is quantity easing more effective for acute financial shocks in the US than for chronic deflation in Japan?
Quantitative easing is a liquidity injection tool. The US faced sudden liquidity crisis where credit markets froze, so pumping money into the system stabilized it quickly. Japan's deflation, however, is driven by structural issues like an aging population and a deeply rooted mindset, where consumers expect prices to fall. QE can boost demand, but it cannot easily cure structural demographics or break decades of deflationary
psychology.
Thank you. Thank you.
Hello, teacher. I am Alasdair from Group A11, and for me, my part, I'll be doing case 2. So let's answer the first question. To answer the first question, we have to know the basic identity of GDP, which is GDP equals consumption plus investment plus government investment and plus net export, like export minus import. This is net export. And in this case, the most important change happened in investment, consumption, and export. Like government investment does not really been haven't really been mentioned in the background article. So let's start with investment, which actually is the main driver of the growth. Companies like TSMC significantly increase capital expenditure, especially in advanced 2nm chip production and packaging technologies. At the same time, global tech companies such as Nvidia, Google, and Amazon expanding their R&D centers and data infrastructure in Taiwan. As a result, investment increased rapidly because they invest in Taiwan. And second, net export, NX. Taiwan's export to United States surged because AI-related chips was doubled within a short period. This reflects Taiwan's domain role in the global AI supply chain. So net export also increased significantly. And finally, we can do consumption. With the stock market reaching record highs, many households experience strong wealth effect. Like, I feel I'm richer because I earn money from stocks. Over 5 million retail investor benefit, which boosts confidence and increased spending on goods and services. Because I feel like I'm rich, then I'll spend money, and then I feel I'm richer and I spend more money. Yeah, it's like this. So consumption increased moderately. And government spending was not the key factor here, so we can assume like it remains same. And next, let's go on to the ADAS model analysis, which maybe the graph will be shown somewhere here. This situation involves both shifting aggregate demand and short-run aggregate supply. So first, let's start with aggregate demand. Aggregate demand shifts right. This is because investment, consumption, and net export, both all of them increase, and this is the component of aggregate demand. So of course, aggregate demand shift right. And second, short-run aggregate supply also shift left. And why? Because further expand the production capacity by building new factories and adopting advanced technology. And this improves productivity and lowers production cost. So in short run, we see a large increase in real GDP, a moderate increase in the price level. Inflation does not rise dramatically because the increase in supply help offset the increase in demand. Let's distinguish between foreign direct investment and foreign portfolio investment. So for foreign direct investment, FDI refers to long-term investment in real assets. So for example, Nvidia building a new headquarters in Taiwan, Google establishing data center in Taiwan, and Amazon expanding infrastructure. This is called real assets. It's not like stocks, those capital assets. And this involves physical presence and control. Physical. On the other hand, FPI, foreign portfolio investment, refers to financial investment, such as buying stocks. Global investor purchasing Taiwanese stocks. If you live in the States and then you purchase Taiwanese stocks, in the market, then this is an example of FPI. This capital inflows increase demand of new Taiwan dollars. So the result is that the new Taiwan dollar appreciates. And for the last question, Let's explain how a rising stock market leads to real economic growth. This works through the wealth effect and the marginal propensity to consume, or MPC. When stock price rises, people feel wealthier. Yes, I'm richer. I bought the right stock. It went from 10 to 12. I'm richer. Yeah. Even if they don't spend all of their wealth, they spend proportion of it. Of course. When stock price rise, people feel wealthier. Yeah. So, for example, if the MPC is 0.6, let's say, then for every $100 of additional wealth, people spend $60. And this initial increase in consumption creates multiplier effect. More spending, more income, more spending, more income, more spending, like the cycle. Yeah. As a result, financial gains in the stock market translate into actual increase in production, income, and employment. And in conclusion, Taiwan's AI bloom is unique because it combines strong demand-side growth for advancement, consumption, and export with supply-side expansion from technology advancement. This leads to rapid economic growth with relative controlled inflation. Thank you. Bye.
Alice, is Taiwan's heavy reliance on the AI industry a potential risk?
Yes, it can be potential risk. While the AI boom brings strong economic growth, over-reliance on a single industry may lead to structural vulnerability. If global demand for AI chips decline or technological competition intensifies, Taiwan's economy could be significantly affected. In addition, this concentration increases exposure to business cycle, making economic fluctuation more volatile.
So how would a decline in US demand affect Taiwan? And does the Silicon Shield truly protect Taiwan?
A decline in the state's demand will likely reduce Taiwan's export, especially in AI-related semiconductors, leading to a decrease in aggregate demand and slower economic growth. As for the Silicon Shield, it provides some level of strategic protection by making Taiwan essential to global supply chain. However, it has also increased its dependence on a few major markets, particularly the States, which could become a risk if geopolitical or economic condition changes.
Thank you. Okay, so now I'll be discussing the macroeconomic consequences of the 2026 USA-Iran war and the resulting global crisis as a result. But first of all, let's compare the energy market disruptions caused by the previous Russia-Ukraine war in 2022 and compare it to the current Iran-US war. So both conflicts disrupted the global supply chain of energy, but the Iran-US war specifically had a much larger impact on oil prices. The Russian-Ukraine war mainly affected European natural gas suppliers and some global oil exporters. However, the Iran-US conflict directly threatened the Strait of Hormuz, and its closure just a few months ago has a detrimental impact on the energy around the entire world and the transport routes. So now looking at the economic figures, approximately 20% of global oil and shipments pass through the narrow waterway of the Strait of Hormuz. And when Iran effectively closed the strait, it attacked the regional energy infrastructure. For example, around 20 million barrels of oil per day were removed from global markets. And as a result, crude oil prices surged roughly from $70 to $120 per barrel with just a few weeks after its closure. And unlike other regional conflicts, this caused gasoline prices to rise around the entire world, which disrupted the major global supply checkpoint, causing immediate worldwide effects for everyone. So next, let's discuss stagflation. Stagflation is a situation in which high inflation and economic stagnation occur at the same time combined. So in terms of the Iran-US war for stagflation, the first economic problem is inflation. Higher oil prices increase production and transportation costs, which causes the firms to raise their prices. And the second problem is rising unemployment and falling output as a result. As production becomes more expensive, firms reduce their output and their investment and also their hiring for unemployment, causing unemployment. And so economic growth slows and unemployment increases. And the issue with stagflation is that for policymakers, solving one problem makes the other problem even worse. So policies are put in place and designed to reduce inflation, but it may slow economic growth. So they need to find a balance between the two. Okay, so looking at this from an aggregate demand and an aggregate supply graph, you can see that the initial equilibrium starts at E1 and AD remains unchanged. Then the short run aggregate supply shifts left from, on this graph, SRAS1 to SRAS2. So the new equilibrium is at E2. And because of this, the higher price level goes onto the vertical axis and the lower real GDP becomes on the horizontal axis. So this graph illustrates a negative supply shock as a result of stagflation and in terms of the US and Iran war. So why does the short run aggregate supply curve shift to the left? And this is because oil is a major production input and rising energy costs increase firms' costs of production across the entire economy. And finally, let's analyse the Phillips curve framework. The traditional Phillips curve framework suggests a short run trade-off between inflation and unemployment. And policymakers can usually choose between slightly higher inflation with lower unemployment or lower inflation with slightly higher unemployment. It's their choice. So over here you can see the original short run Phillips supply curve, and you can see the new short run Phillips supply curve, which shifts upwards and right. And higher inflation and higher unemployment occur at the same time. And this is because the oil shock causes the entire short run Phillips curve to shift upwards, meaning that for any unemployment rate, inflation is now higher than it was before, proving that stagflation exists. Thank you.
So I would like to ask, could higher oil price ever benefit some countries instead of hurting them?
Yes, so while oil importing countries such as Japan, South Korea and many of the European nations are negatively affected, some higher energy cost oil exporting countries could benefit. For example, Saudi Arabia, UAE and Norway significantly have higher export revenues when oil prices rise. However, from a whole global perspective, the overall effect is usually negative because higher energy costs reduce production and consumption in major economies.
And I want to ask, why can governments simply use both expansionary fiscal policy and expansionary monetary policy to solve stagflation?
So expansionary fiscal and monetary policies can help increase economic growth and reduce unemployment by boosting the aggregate demand. However, because of stagflation, the main problem originates from the supply side of the economy. And since production costs have already risen due to expensive oil, it may worsen inflation even further. So while these policies can partially offset the GDP's fall, they generally cannot eliminate both high inflation and unemployment at the same time.
Thank you.
Thank you for watching.
We are group A11.
Please give up full mark!